An extraordinary and deeply significant event occurred within the borders of China this week that the vast majority of global observers completely failed to notice or comprehend. I'm not referring to some minor or obscure economic statistic that only specialized academic researchers or institutional economists track in their spreadsheets. Instead, I'm discussing a market signal so intense, so loud, and so undeniably clear that once you truly grasp its underlying implications, your perspective on the global silver market will be changed forever. A major investment vehicle was forced to suspend all active trading operations, not because the price of silver had suddenly collapsed or due to some temporary technical software failure, but specifically because consumer appetite was so relentless and overwhelming that the fund valuation disconnected from the actual physical asset value by a staggering 36%. Let me emphasize that specific figure one more time, as you must fully comprehend just how truly bizarre and abnormal this situation is for a modern financial market. Participants were essentially offering to pay 36% more than the fair market worth of the actual physical silver the vehicle was designed to represent and track. This is not a minor rounding error, nor is it typical market noise that occurs during standard volatility. It is sheer financial desperation manifesting in the institutional world. The UBS SDIC Silver Futures instrument, which currently serves as the primary and essentially only pure exposure investment vehicle available for Chinese retail participants, declared an emergency pause in all operations until 10:30 in the morning Beijing time. Furthermore, the management team took the drastic step of completely halting any and all new capital inflows from investors. This was not some impulsive or sudden choice made in a vacuum without prior warning. Since the early days of December, the fund management had been broadcasting frequent and urgent risk alerts to the general public. They repeatedly paused activity in an attempt to dampen a buying frenzy that simply refused to subside. Eventually, they reached a total breaking point and simply declared to the world that they could no longer manage the escalating chaos. Now, consider the broader context that makes this development even more fascinating for those watching the precious metals sector. These events are unfolding precisely as silver reaches a historic peak of $117.71 per ounce. It is occurring while the metal has surged over 50% since the current calendar year began. It is happening while domestic prices in the Asian market are trading significantly above comparable Western benchmarks, even after you carefully factor in the 13% value-added tax required for any physical importation. Every single piece of available data confirms the same reality. The physical bullion landscape is fracturing under stress in ways that most North American and European investors fail to recognize or appreciate. As I record this analysis on Wednesday, please take a moment to share your current local time in the comments section below. I'm always genuinely fascinated to see the global reach and diversity of this community as it spans across every time zone. Seeing the various regions represented in our community is truly a humbling experience for me. Also, if you find this deep dive analysis valuable and haven't officially joined our channel yet, please click the subscribe button right now. It takes only a single second and significantly supports the continued growth and reach of this platform. Don't forget to join our private community on WhatsApp and follow our real-time updates on X, the platform formerly known as Twitter. Those specific platforms allow us to share immediate market insights and maintain a continuous dialogue between our major video uploads. You can find all the necessary links conveniently located in the video description below. Here is our detailed agenda for today's extensive market breakdown. Initially, I will dissect the precise mechanics of the Chinese fund dislocation and explain why a 36% premium is more significant than any technical chart pattern you have ever analyzed in your career. Then, we will broaden our perspective to examine the global supply-demand deficit, because this specific fund crisis is merely a visible symptom of a much larger and more dangerous systemic problem. Following that, I will clarify why massive and growing industrial consumption has built a structural price floor that most traditional Wall Street analysts continue to underestimate or ignore. We will then analyze the current gold-to-silver ratio and what previous historical market cycles suggest about where our current trajectory might be heading in the coming months. To conclude, I will provide a practical mental framework to help you navigate the intense psychological pitfalls and emotional traps that often ruin investors during periods of high market volatility. You're going to want to stay tuned and watch this entire presentation through to the end, because this information is vital for your strategy. Let's begin with the specific mechanics of the fund, as I believe many people misunderstand the gravity of what a 36% premium actually represents. Under normal market conditions, when you purchase a silver tracking fund, you should pay a price that is roughly equal to the metal's underlying spot value. If the entity holds exactly $100 worth of bullion contracts, your share of that fund should cost you approximately $100. That is the fundamental design and intended function of these financial instruments. Market specialists and arbitrageurs are specifically tasked with keeping the share price tightly linked to the value of the actual assets. When a slight premium emerges, professionals sell the overpriced shares and acquire the cheaper underlying metal. When a discount appears, they do the exact reverse. This continuous balancing act is what maintains equilibrium in a healthy market. But consider what occurs when demand accelerates so rapidly that these traditional balancing mechanisms fail to function. The premium begins to widen and continues to expand until people are paying $136 for an asset that is only worth $100. That is the stark reality of this 36% price gap. Chinese participants are so hungry for silver ownership that they are willing to overpay massively just for the basic privilege of having exposure to the metal. The fund administrators explicitly cautioned that such a high premium is logically unsustainable in the long run. They warned that participants could suffer immense capital losses if the market suddenly decides to recalibrate. That is not just polite financial jargon. That is a manager shouting that they can no longer protect the public from their own buying enthusiasm. When a major institution stops trading specifically to save people from their own actions, you are witnessing an extraordinary historical moment in the financial world. Now, reflect on what this suggests about the general investment environment currently existing in China. This particular fund is essentially the only accessible silver-focused instrument for the vast local population. If you seek silver exposure via a regulated exchange, this is your primary and most liquid gateway. While physical coins and bars do exist, they involve significant logistical hurdles and transaction friction. Furthermore, the complex futures market remains largely out of reach for the average retail person. Therefore, when this vehicle shuts its doors, it effectively blocks a massive demographic of over 1 billion people from participating in the silver market through that channel. What do you think happens to the total demand for metal when the digital paper alternative is suddenly removed? It does not simply vanish into thin air. It simply migrates to other areas. We are seeing clear evidence of this transition right now. Major refiners and manufacturers in the region are pivotally shifting their production away from decorative jewelry and toward the manufacture of 1 kilogram silver investment bars, because that is what the public is demanding. They are not seeking fashion or beauty. They are seeking wealth preservation and security. They want tangible metal they can physically control, something that does not depend on a fund manager's ability to keep the doors open during a crisis. This cultural and behavioral pivot is monumental in its scope. When a population of that size begins treating silver as a core monetary asset instead of a simple decoration, the impact on global inventory is profound. The shift is occurring simultaneously with record-breaking industrial consumption that shows no signs of slowing down. The global photovoltaic and solar sector requires massive amounts of silver. The electric vehicle industry is increasingly hungry for it. The entire infrastructure of the global green energy transition depends fundamentally on this metal. You have a massive pull from industrial users on one side and an explosion of investment demand on the other. Meanwhile, the global supply side is simply incapable of keeping pace with this dual-pronged attack on inventory. Let me provide some vital context on the production side, because this is where most people get the silver story wrong. Silver is entirely unique among major commodities. Approximately 70% of the total global silver output is actually produced as a byproduct of mining for other industrial metals like copper, lead, and zinc. This means that silver production does not automatically or easily increase just because the price of silver goes up. You cannot simply open a new silver mine in response to higher prices if the economics of the primary base metals being mined do not support that expansion. Even if such an expansion is justified, the lead times for bringing new projects online are measured in years, not months. This structural limitation creates a massive bottleneck where demand can skyrocket while the supply remains essentially stagnant. The only way the market can balance itself is through the depletion of existing stockpiles, increased recycling, or a price spike large enough to force current long-term holders to sell their metal. When all three of these safety valves are pressured at once, you get the volatile and explosive environment we see today. MKS PAMP, a global titan in the precious metals trading and refining world, has officially stated that current demand levels are unlike anything they have ever seen in their history. This is not just hype from a social media influencer or a retail enthusiast. It is a direct observation from the people who actually move physical metal across continents and through customs. When the global logistics experts say the current situation is unprecedented, it is time to pay very close attention. Consider this specific detail. Silver is now being shipped via expensive air freight instead of standard ocean vessels in several key international corridors. Think about the implications of that shift. Air transport is exponentially more expensive than shipping by sea. The only logical reason to choose that route is if the urgency is extreme and the need is immediate. If the metal is required right now and cannot wait for a slow cargo ship, the extra cost becomes secondary to the need for possession. This is not a sign of efficient logistics. This is a desperate scramble for physical survival in a market where delivery schedules have completely collapsed. Massive quantities of metal are also moving rapidly toward the Indian market. India has always been a primary consumer of bullion, and that hunger is certainly not fading in the current environment. Meanwhile, the steady and visible drain of inventory from Western warehouses has shifted the epicenter of the crisis toward the east. The total picture is one of global scarcity. There simply isn't enough refined silver to satisfy everyone at these current valuations. Now, let's examine the situation outside of Asia, because those extreme premiums are starting to dictate sentiment everywhere else. Ola Hansen, a lead commodity strategist at Saxo Bank, made a brilliant observation recently that I think is crucial. He suggested that as long as Asian premiums remain this high, traders in New York and London will be emboldened to believe that Western prices are still far too low by comparison. This premium is not just a local quirk or a temporary anomaly, it is a global beacon that influences how every major player perceives the true value of the metal. This is the very essence of global price discovery. Geographic anomalies eventually force a global adjustment toward the higher price. When professional traders see Chinese buyers willing to pay 36% extra, they begin to question if the global benchmark spot price is fundamentally wrong. That realization creates intense and persistent upward pressure, even in markets that appear stable on the surface. Please leave a comment below if you have been monitoring these developments in China yourself. I want to know if this is a new revelation for you, or if you have been tracking it closely for some time. Your unique insights often provide more value than the mainstream headlines themselves. Let us pivot our focus to the industrial sector, because this provides the ultimate structural safety net for silver prices moving forward. Silver is not just a hedge against inflation or a secondary monetary backup. It possesses physical attributes that are literally irreplaceable in our modern technological world. It has the best electrical and thermal conductivity of any known element on the periodic table. It is antimicrobial and highly reflective. Every single solar panel installed globally requires silver paste to function and conduct energy. The solar industry's growth is currently exponential as nations rush toward their renewable energy targets. This is not a speculative future trend. This is daily massive consumption that increases every single quarter. Electric vehicles represent another massive engine for demand. Each new EV utilizes significantly more silver than a traditional internal combustion car for battery management, sensors, and charging hardware. This transition is being mandated by governments and driven by massive consumer shifts. It isn't slowing down, it is accelerating. The broader technology world uses silver in ways you likely never even imagine in your daily life. The massive data centers powering artificial intelligence and global social media require silver for thermal cooling and connectivity. 5G networks and advanced circuitry all rely fundamentally on this metal. Our entire digital infrastructure is built on a silver foundation. However, there is a subtle but important point you must understand. If prices climb high enough, some manufacturers will inevitably attempt to find substitutes like copper or aluminum to save money. This creates a natural ceiling on how high the price can go before demand is eventually destroyed. But substitution is not an overnight process. It requires years of engineering research, testing, and retooling expensive factories. In the meantime, companies have no choice but to pay whatever the market price is to keep their production lines running and fulfill their contracts. This creates a scenario where industrial needs provide a hard floor, while the ceiling remains a moving target far in the distance. The current price above $110 is definitely causing stress for manufacturers, but for many, the global green transition is not an option they can simply opt out of. Mandates and competition force them to continue their work, regardless of the input costs. This suggests industrial demand will remain very sticky even at these higher levels. Now, let's look at the gold to silver ratio to find perspective. With gold trading north of 5,000 and silver at 115, the ratio is currently sitting at roughly 44-1. Historically, this relationship has swung wildly over the decades. In 2011, it hit 32-1. During periods of extreme neglect, it has blown out to 80-1 or even higher. The long-term historical mean is closer to 65-1. This tells us that silver has been leading the current charge and outperforming gold. The ratio has compressed from 80 down to the mid-40s in a very short window of time. If we were to return to the 2011 low while gold remained at 5,000, silver would need to reach a price of approximately $156. That is not a guarantee or a prediction. It is simply a mathematical framework of what is possible based on historical precedent. But I must offer a stern warning. The speed of this move is nearly unprecedented in market history. Such rapid changes often lead to sharp corrections or long periods of boring sideways trading. The market does not move in a straight line. It moves in violent waves designed to shake out the weak and the overconfident. Now, let's look at the broader macro environment. The US dollar has been steadily weakening against other global currencies. The current administration has signaled they are comfortable with a softer dollar to help domestic exports remain competitive. When the global reserve currency loses value, hard assets priced in that currency naturally rise. It also reinforces the story of currency debasement that has fueled bullion demand for many years. If you believe that national debt and deficits will continue to grow, silver becomes a very logical lifeboat. Central banks are also buying precious metals at record paces. This is the smart money making a strategic choice to diversify away from the dollar system. When sovereign nations start hoarding metal, they are sending a powerful message about the future of the international monetary system. Even major investment banks like Citi have raised their silver targets to $150 recently. When institutional analysts at that level make such bold calls, it shows the bull case has moved from the fringes into the mainstream investment world. But here's the part where I need to be perfectly honest and offer some tough love. Everything I just listed sounds incredibly bullish, and that is exactly why you should be very careful with your capital. When a market narrative feels this perfect, the market often delivers its most painful and unexpected surprises to the majority. The people who lose the most money are not usually wrong about the big picture. They are simply wrong about their timing and their internal emotions. Silver could easily drop $20 tomorrow and still be in a healthy long-term uptrend. Could you personally handle that kind of volatility? If a 20% pullback would cause you to panic and sell your position, then your position is simply too large for your risk tolerance. You must size your holdings so you can sleep peacefully through the volatility. Distinguish between your long-term fundamental thesis and your short-term price predictions. Your thesis can be entirely right, even if your short-term timing is wrong. Understand the difference between holding physical metal as a generational store of value and trading leveraged futures for a quick profit. They are two entirely different games with different sets of rules. I want to hear your specific strategy in the comments. Are you a long-term physical accumulator or a short-term trader? Sharing your experience helps the whole Commodity Advisor community stay grounded and focused. Finally, let's talk about physical premiums one more time. When paper prices and physical prices diverge, the market is essentially broken. Right now, buying a silver bar requires paying a significant markup over the spot price. In times of crisis, these premiums can skyrocket. If you buy at a high premium and sell when things are calm, you might lose money even if the metal price went up. This is why discipline and process are more important than just being right on the direction. The 36% premium in China is a warning that urgency is reaching a boiling point. Lastly, look at the inventory data. Registered silver stocks in major vaults have fallen by 70% since 2020. The margin for error in the system has completely evaporated. A single large buyer could now trigger a massive and historic short squeeze. All the signs are there: the fund halt, the air shipments, and the collapsing inventories. We are entering uncharted territory. The market exists to transfer wealth from the impatient to the patient. Do not let it take yours. Make sure you join our community on WhatsApp and follow us on X for real-time updates. Everything here is for educational purposes. I'm not a financial advisor, so do your own research and make your own choices. Stay focused, stay skeptical, and I will see you in the next video.